everyone. Today we are going to continue with Chapter 10 Accounting Rules. We have started to learn about accounting rules, accounting principles, and understand the ways in which the quality of information in accounting statement can be measured. So I hope you still remember those 11 accounting principles and 4 quality of information in this accounting statement. Don't forget to complete the quiz I have prepared for you before you start this. Okay, so today we are going to understand more on the difference between capital and revenue expenditure and capital and revenue receipts. You could understand the basis of stock or inventory valuation and prepare simple stock or inventory valuation statements. So what are the capital and revenue expenditure and receipts? So first of all, you need to understand what the meaning of expenditure. It means the spending paid by the business or paid by the business, and receipts shows the income earned by the business. So why do we differentiate the expenditure and receipt into capital and revenue expenditure? Because the word capital is mainly shows that this amount of revenue, so this amount of expenditure or receipt are relevant to the non-current assets. The revenue, expenditure, and receipts are mostly relevant to day-to-day basis operation, not relevant to the non-current asset, buying or selling of non-current assets. What is capital expenditure? Capital expenditure is incurred when business spends money either to buy non-current asset, add to the value of an existing non-current asset, bringing them into the business, and the legal cost of buying the buildings, plus any other cost needed to get the non-current assets ready for use. So for example, when the business buy a house, the house needs renovation. It's an empty house. The house needs renovation. So the renovation cost is the cost added to the value of the house. That is also part of the capital expenditure. Plus, to buy a house, the business would need to sign the sales and legal agreement drafted by the lawyer. So it involves legal costs. That lawyer fees is also part of the capital expenditure. After that, after the renovation done, then the business might need to bring in some furniture. The cost of delivery of these furniture for the non-current asset ready for use is part of the capital expenditure. So I show you the examples of capital expenditure. Then what is revenue expenditure? Revenue expenditure is not spent on increasing the value of non-current assets, but is incurred in the running of the business on a day-to-day basis. So the cost of buying the car, making the car ready for you, the insurance of the car is revenue expenditure because it needs to be paid regularly. The petrol cost of van, repairs to van, electricity cost of using machinery, repainting a building, these are all revenue expenditure. Capital receipt. How does the business gain capital receipt? When the business sells an item of capital expenditure. For example, the sales of used van. Revenue receipt show the sales and other revenue items that are added to the gross profit. The revenue receipt is not sales. Okay, it's other income received or receivable by the business, such as rent receivable and commission receivable. On top of that, we should value the inventory properly according to the accounting rules. What is the basis of valuing inventory? Inventory is always valued at the lower of cost or net realizable value. What is cost? Cost of inventory equal to the purchase price plus carriage inwards. Carriage inward is the delivery cost of carrying the inventory from the supplier to the business. Net realizable value equal to estimated receipts from the sale of stock minus the cost of completing goods. If it's damaged, then the cost of fixing it is the cost of completing the goods, and cost of selling the goods. Cost of selling the goods can be carried outwards, which is the delivery cost for transporting the products to the customers. Why are we doing this? This is based on prudence concept. Not overvaluing the stock because it will cause both the profit and asset to be overvalued. I will show you how does this work later. For example, Dover sells two different types of stock, type A and B. They provide the following information at 31st December 20-6. So we have two types of stocks here. Units in stock for A is 94, cost price per unit $20, net realizable value per unit $18. So if we just base on this number, which value would you choose to value the stock A? The answer is, for now, you should choose the $18 lower of cost or net realizable value. So $18 is lower than the cost for type A. So we will choose $18. Type B, 38 units in stock, cost price is only $15. Net realizable value per unit, $19. So which one do we choose? The answer is $15 because $15 is lower than $19. If we choose $19, $20, then the stock value, the inventory value will be overvalued. However, we do not ignore the additional information given. The cost price per unit of stock A does not include carriage inwards of $1 per unit. So it makes the cost prices even more expensive. It will cost 50 cents per unit to bring type A goods into a sellable condition. It means type A good is not totally net selling at $18. There's some cost of selling which is 50 cents. 12 units of type B were damaged and would only be able to sold for 10 units per $10 per unit. $10 is definitely lesser than $15. So because of this, we can't use $15 as the value for stock B for these 10 units. We must apply a new lower value, which is the value after damage. Look at this statement. Prepare a statement to show the value of the closing inventory at 31st December 20-6. For type A, 94 units at 17.5. Why is it 17.5, not 18? Because I have mentioned to you that's 50 cents per unit to bring type A goods into a sellable condition. So this 50 cents is minus from the $18. So multiply these two amounts to give $1,645 as the value of type A. Type B, 12 units at $10. Why is it $10? Because these are the damaged goods. Would only be sold at a lower price, plus the remaining units, 26 units at $15 is $390. Add these two values together. This is the inventory value for type B goods at the end of the 1st December 20-6. The total value of inventory for Davao is $2,155. So if you still can't understand, you may read this part for your understanding. So next, what happens if Davao doesn't follow the stock valuation, inventory valuation rules? You must understand it will have impact on the gross profit profit, his capital account, and the current asset for the year. So for example, the closing inventory on 31st December 20-7 will be brought down to become the opening inventory on 1st January 20-8. So these two values are the same. So if the closing inventory is being overvalued by $50, the same will happen to the opening inventory on 1st January 20-8. So let's see what happened. After the preparation of his financial statements for the year ended 31st December 20-7, Dawal discovered that he had overvalued his closing inventory by $50. Complete the following table by placing a tick in the correct columns to show the effect of this. I have done it for you. So let's analyze. Why would the overvalued of his closing inventory by $50 in the year of 20-7 will cause the gross profit for the year overstated? This is because closing inventory is deducted from the cost of sales. Okay, how do you get gross profit? Revenue minus cost of sales, right? So if the closing inventory is higher, that means the cost of sales will be lower. So if cost is being overstated, gross profit for the year will be if cost is being understated, then the gross profit for the year will be overstated. Same happens to the profit for the year. If other variables remain the same, the increase in gross profit should be increase the profit as well. And profit for the year will be added to Dawal's capital at 31st December 20-7. So the same thing happened. Dawal's capital is overstated. And current asset at 31st December 20-7 is also overstated. Why is it overstated? Because closing inventory value is part of the current assets. So if closing inventory has been overstated by $50, so all these items will be overstated by $50. Coming to year 20-8, why would the closing inventory value in 20-7 be affecting 20-8? Don't forget, the closing inventory of one year is the opening inventory of the other year. Opening inventory is part of the cost of sales to calculate gross profit. So if closing inventory was overvalued in the previous year, that means the opening inventory in the current year 20-8 would also be overvalued, which will cause the cost of sales to be overstated and gross profit understated. Same thing happened to profit for the year. However, there will be no effect of Dawal's capital and current asset at 31st December 20-8. Why? Because the effect of overstated in 20-7 for these two items have been compensated by the understated effect of gross profit and profit for the year in 20-8. So since this has become an adjustment, so Dawal's capital and current assets value will go back to the normal value. So this is the end of today's lesson. If you have any questions, please ask me through email or writing a private comment of this assignment. Thank you very much.